On the 22nd of June, SK Hynix became the most valuable company in South Korea, passing Samsung Electronics for the first time in more than 25 years. 3 days later, the Korea exchange halted trading. Within 24 days, the index had fallen about 27% from its record high. And after all of that, it was still up roughly 62% for the year. This matters now because the volatility has not stopped. In the first week of August, the KOSPI moved more than 4% on 3 separate sessions, falling almost 5% on one day and rebounding sharply on another. On the 10th of August, it closed around 6,300. That is down about 7% over the previous month. It is also up about 96% from where it stood a year earlier. Both of those things describe the same index over the same period. Korean equities rose roughly 75% during 2025, driven by demand for memory chips used in artificial intelligence systems, and the rally carried into this year before it reversed. What is established is the structure underneath the moves. Samsung Electronics and SK Hynix together account for more than half of the index by market capitalization. When those two move, the index moves. In July, Samsung fell about 21% and SK Hynix fell about 35%. The index closed the month down 22%, its steepest monthly decline since October 2008. Roughly 250 trillion won of market value was erased. The Korea exchange triggered 7 circuit breakers over the year. 3 of the 11 circuit breaker events in the entire history of the index happened inside a single month. Retail investors had put approximately 78 trillion won into the market during May and June alone, a large share of it through single-stock leveraged products that multiply exposure to one company. Regulators have since suspended new listings of those products. What is genuinely disputed is what caused it. KB Securities described the fall as short-term distortions in trading dynamics rather than weakening fundamentals, arguing that only around 60% of large technology companies' memory demand is currently being met, and that new capacity takes years to build. Goldman Sachs made a similar argument, framing the selling as positioning rather than deteriorating business conditions. Morgan Stanley moved Korean equities to overweight during the decline. Against that, the deleveraging explanation cuts both ways. If crowded borrowed positions were the reason prices fell this far this fast, those same positions have to finish unwinding, and that process produces more large swings on the way through. Neither reading has been settled by what has happened since. Here is the part worth sitting with. On the day the index rebounded 18%, retail investors sold a record amount. Not during the fall, during the recovery. That is a pattern that shows up in every market, in every country, in every decade. Conviction survives the first drop and dies somewhere in the middle of the second one, and by the time the price comes back, the position is already gone. 2 things made it possible here. Concentration nobody consciously chose, because buying an index that is more than half 2 companies is a concentrated bet, whether or not it feels like one. And leverage, which does not change the direction of a move, but does change how long you can sit through it. If you have ever sold something and then watched it recover, the useful question is not whether the sale was correct. It is what you were feeling in the days before you placed it, and whether that feeling has shown up before. It is exactly what Whisper was built to show you. Whisper.live.